the governor of the Bank of England, has issued a stark warning against any relaxation of the financial regulations implemented in the wake of the 2008 global financial crisis. In a forceful statement, the governor emphasized the critical importance of maintaining robust financial stability, asserting that there is no trade-off between achieving economic growth and ensuring the resilience of the financial system. This declaration directly contradicts recent efforts by some within the government to pursue deregulation as a means of stimulating economic activity. The governor's position stands in sharp contrast to the views expressed by certain government officials, notably the Chancellor, who previously advocated for a more lenient regulatory environment. Last year, during her Mansion House speech, the Chancellor indicated to city bankers that the post-2008 regulatory protections had gone too far, signaling a broader policy shift toward deregulation to foster economic growth. This sentiment reflects a wider governmental push to stimulate the economy through less stringent regulation. The Chancellor's stance led to concrete actions aimed at reducing regulatory burdens on financial institutions. A key element of this initiative involved instructing the Financial Conduct Authority, FCA, the UK's primary financial services regulator, to promote a culture of sensible risk-taking among banks, asset managers, and insurers. This directive aimed to encourage greater investment and economic activity by reducing perceived regulatory constraints. The message was clear. The government prioritized boosting economic growth, even if it meant accepting a potentially higher level of risk within the financial system. Furthermore, the government's commitment to deregulation extended beyond mere guidance to the FCA. Earlier this year, ministerial intervention led to the removal of the chair of the UK's competition watchdog, a move interpreted by many as an attempt to curb regulatory oversight. Beyond this high-profile dismissal, the government summoned other regulatory bodies to Downing Street, issuing direct demands for the dismantling of regulations deemed to be hindering economic growth. These actions signaled a determined effort to reshape the regulatory landscape, prioritizing deregulation above all else. The governor's strong counterargument highlights a fundamental disagreement regarding the appropriate balance between economic growth and financial stability. The governor's position emphasizes the potential long-term consequences of excessive deregulation, arguing that weakening financial safeguards could ultimately jeopardize the very economic growth it is intended to stimulate. A destabilized financial system, the governor implies, could trigger a far more severe economic downturn than any temporary benefits derived from reduced regulation. The governor's message underscores a crucial debate at the heart of economic policy: the delicate balancing act between fostering growth and maintaining a robust and resilient financial system, a balance potentially threatened by a rush towards deregulation. This inherent tension necessitates a nuanced and careful approach, ensuring that the pursuit of growth does not inadvertently sow the seeds of future instability. The governor's intervention serves as a critical reminder of the potential long-term costs of prioritizing short-term economic gains over the sustained stability of the financial sector.